This video contains affiliate links. You may see referral fees mentioned, but at no extra cost to you because these are the best tools in the industry. Trump accounts are established under Section 530A of the Internal Revenue Code. And starting in 2026, they become one of the most powerful new ways to stack money for your kids with tax advantages you have never had before. In this video, you will understand exactly how Trump accounts work in 2026, the Section 530A rules you cannot ignore, how the one-time $1,000 government pilot contribution for eligible children works, and how employers can add up to $2,500 per year through Section 128 programs to supercharge these accounts for your family. If you are a parent, a future parent, or an employer who wants to use the tax code the smart way instead of just hoping Social Security is enough, you need to see how these rules actually play out in real life. Here's why this matters right now, starting July 4th, 2026. Contributions can begin flowing into these Trump accounts for eligible children under age 18 with a Social Security number, and the earlier you start, the more time compounding has to work for your kid's future, retirement, or big life goals. During what the tax code calls the growth period, which runs up until January 1st of the calendar year in which your child turns 18, money sits inside this account as a special kind of IRA-style vehicle for the exclusive benefit of that child, with restrictions on withdrawals but powerful tax benefits if you play by the rules. Most people will either ignore this, thinking it is some political gimmick, or they will assume it is just another 529 plan. And that mistake alone could cost their kids tens of thousands of dollars in long-term tax-advantaged growth because the rules, the contribution sources, and the way withdrawals are taxed are different from the old-school tools. What you are getting here is a clear breakdown of Section 530A, how the new accounts compare to things like 529s and Roth IRAs, how the $1,000 government pilot contribution actually gets triggered, and how to position yourself so you do not leave free money and tax benefits sitting on the table. Before going deeper, if you are a parent or an entrepreneur planning to build real wealth for your family, you also want clean business structures in place. And that is where an LLC set up correctly can separate your business risk from your personal and family assets. Something formation services like Busy handle from registered agent to IN, so you are not drowning in paperwork while you are trying to focus on long-term wealth. Link in the description if you need that handled for $0 plus state fees. Now, let us get into the rules of Trump accounts in 2026 and how they really work for you, because the next part is where most people either get ahead or get left behind. First, Trump accounts under Section 530A are built for children under 18. They are set up for the exclusive benefit of that child, and no withdrawals are allowed during the growth period, which means you cannot treat this like a regular savings account you dip into. When things get tight, it is a locked-up long-term play. That lockup scares some people, but here's the key. During that childhood window, the account is accumulating investment returns in a tax-advantaged way, similar to an IRA, and when the child hits their age 18 year, investment restrictions loosen and it essentially shifts into a traditional IRA-style account with more flexibility around how the money is invested and eventually withdrawn under normal retirement rules. So if you open one of these accounts for a baby born in late 2025, and you start funding it when contributions open in July 2026, so that kid can have 18 years of tax-advantaged compounding before normal adult IRA rules even begin to apply. And that is without them putting in a single dollar from their own paycheck. Stick with this because the next part is where things move from nice to have to you are leaving free money on the table if you ignore it. Now, Trump accounts get interesting when you look at where the money can come from. There are three main sources during that growth period: the government pilot contribution, employer contributions under Section 128, and contributions from parents and others, all interacting with a $5,000 annual cap in a very specific way. The government provides a $1,000 pilot contribution for eligible children, specifically kids born after December 31st, 2024 and before January 1st, 2029, who are United States citizens with a Social Security number. And this contribution is tax-free and does not eat into the $5,000 annual contribution limit in the same way as private money, which is huge. To actually get that $1,000, you or the guardian have to elect into the pilot program, typically by filing Form 4547 or using the online tool the IRS says will be available. And once that election is in, Treasury sends the information needed to activate the account so the pilot money can land in the child's 530A account after July 4th, 2026. What kills people is assuming that just because their baby exists, the government automatically drops the at $1,000 in there. You actually have to make the election in that pilot window, or that free seed capital never hits your kid's account. Next up, employer money. And this is where you can stack serious value if you or your partner work for the right company, or you run your own business and are willing to design a program for your employees. Section 128 explicitly allows employers to contribute up to $2,500 per year to Trump accounts for employees or their dependents. And that money is excluded from the employee's taxable income, which means it does not show up as wages for tax purposes. These Section 128 employer contributions, combined with other private contributions like parents and relatives, are subject to a $5,000 annual limit during the growth period. But the $2,500 employer cap is its own ceiling inside that bigger bucket. And it is indexed for inflation after 2027, so over time that employer amount can creep higher. Employers can design a written Trump account contribution program that sends money either to a minor employee's own Trump account or to the Trump account of a dependent. For example, your company could put $1,500 into each employee baby's account every year as a benefit. And it would still be tax-free to the employee and treated as a contribution to that child's 530A account within the limits. Employers can contribute up to $2,500 annually under Section 128, which means in the optimal setup, your kid could get $1,000 from the government pilot program once, $2,500 per year from an employer program, and additional contributions from you as parents up to the $5,000 annual contribution cap, all stacking inside one tax-advantaged account. Now here's the crazy part. While cash is going in from different sources, the tax code is watching total contributions carefully. If you blow past the annual limit with excess contributions, the rules layer on penalty-style tax treatment similar to other IRA excess contribution rules. Section 530A lays out that if contributions exceed the allowed limit and you do not fix it by pulling the excess out on time, there is an extra tax charge based on the net income attributable to that excess amount, which can quietly eat into the gains you were hoping to protect for your kid. The fix is simple, but requires attention. You monitor contributions relative to the $5,000 limit during the growth period. And if you are near the top because an employer and grandparents are being generous, you coordinate so that in any given tax year, you do not spill over and trigger penalty treatment on the extra funds. Beginning in the age 18 year, those special childhood restrictions drop away. The account shifts to being invested like any other traditional IRA, which means normal IRA-style rules on contributions. Distributions and penalties start to guide how your now adult child can use the money over their lifetime. There is no taking money out during childhood for emergencies, college, or a first car. It is not designed for that. It is designed for long-term wealth building and retirement-style security. And that is why policymakers tied it so tightly to IRA-style rules after the growth period ends. In simple terms, you are turning government money, employer benefits, and your own contributions into a long-term retirement seed that starts compounding for your child before they can even drive a car. And that early compounding is the entire point. Now, let us talk about how you, as a business owner or employer, can actually use this in the real world. If you are an entrepreneur with kids and you pay yourself through your own company, you could design a Section 128 Trump account contribution program inside your business. Then, as an employee of your own company, you become eligible, just like any big corporate worker, allowing your company to send up to $2,500 per year into Trump accounts for your children, all while that money is not included in your W-2 income. That is effectively shifting money out of taxable wage income and into a tax-advantaged child account, within the contribution limits, and using the business as a vehicle to move cash in a more efficient way than just cutting your kid check from your after-tax paycheck. To do that cleanly, you need your business set up correctly. And for most people, that means using an LLC taxed properly, which is where services like Busy are extremely useful. Handle the articles of organization, registered agent, and EIN. Then layer on a written Trump account contribution policy. And you have created a structure where your company is legally contributing to your children's future in a tax-favored way. If you are on the other side, an employee at a company that offers Trump account contributions, your playbook looks different. Step 1 is make sure your eligible child actually has a 530A account set up, which will require going through the activation process once the IRS systems and custodians are live after mid-2026. Step 2 is elect into any available pilot program to capture that. $1,000 government seed contribution if your child's birth dates qualify, and Step 3 is enrolling in your employer's Trump account program so contributions actually flow each year. The mistake a lot of employees make with benefits like this is thinking the HR announcement is optional and they will do it later. But if there are annual enrollment windows or required forms, missing those means missing a whole year of tax-free employer money flowing into your child's account, which is like declining a raise. Before moving to the last part, drop a comment with your situation. Are you a parent, future parent, or employer? And are you planning to use Trump accounts once contributions open in 2026? It helps to see how many people are actually paying attention to this. So what are your action steps from here? And how does this fit into your bigger wealth plan? Today you saw that Trump accounts are established under Section 530A of the Internal Revenue Code, that they are built as tax-advantaged IRA-style accounts for children under 18 with a strict no withdrawal growth period, and that the government provides a $1,000 pilot contribution for eligible kids born between late 2024 and 2028. If you actually elect into the program, you also saw that employers can contribute up to $2,500 annually under Section 128, that those contributions are excluded from the employee's taxable income, and that combined employer and private contributions are subject to a $5,000 annual cap during childhood. So coordination is everything if you want to max the benefit without triggering penalty taxes. Your next step right now is simple. If you have or plan to have kids in that eligibility window, put a reminder on your calendar for mid-2026 to check with your tax advisor, HR department, or financial planner about activating a 530A account. If you do not even have your basic business structure set up yet, get that done first. Busy can handle your LLC formation for $0 plus state fees. Get your EIN. And keep you compliant so you can actually use advanced tools like Trump accounts and employer contribution programs without worrying that your foundation is broken. Link is in the description. If you found this breakdown helpful, tap subscribe, hit like, so this video reaches more parents and business owners who have never even heard of Section 530A, and drop your questions below. Every comment helps guide future videos.